Warren Buffett is a name that commands respect in the world of investing. The Oracle of Omaha has built an empire through smart, calculated decisions, transforming Berkshire Hathaway into one of the most valuable companies in the world. His disciplined approach, focused on value investing, has made him one of the richest and most admired investors of all time. But even the greatest investors are not immune to mistakes. And sometimes the biggest regrets aren't the bad investments they made, but the great ones they missed. This is a story about one of Buffett's biggest regrets. A missed opportunity so colossal that it still haunts him to this day. An investment that, had he made it, could have added hundreds of billions of dollars to Berkshire Hathaway's portfolio. To understand this, we first need to dive into Buffett's investment philosophy. The principles that built an empire. Buffett's investing style is famously simple yet incredibly effective. He follows the principles laid out by his mentor, Benjamin Graham, the father of value investing. The core idea? Buy undervalued companies with strong fundamentals and hold them for the long term. Buffett looks for businesses with these key characteristics. Strong competitive advantage, a moat that keeps competitors at bay. Stable earnings, predictable cash flow, and long-term profitability. Great management, leaders who are honest and competent. Fair valuation, buying at a price lower than intrinsic value. This approach has helped Buffett make some of the most legendary investments in history. Coca-Cola. Buffett started buying shares in 1988 and still holds them today. A $1 billion investment turned into over $25 billion. Apple. He initially hesitated but eventually invested in 2016. That decision turned $36 billion into over $150 billion. American Express, Geico, Dairy Queen, Bank of America, all prime examples of his long-term, patient investing strategy. But despite these successes, there was one company that slipped through his fingers. A company that fit all of Buffett's investment principles perfectly. A company that would become the most valuable corporation on earth. A giant in the making. In the early 2000s, Buffett was already a legend, but the tech world was evolving at a rapid pace. Silicon Valley was churning out innovative companies that were redefining industries. Yet, Buffett remained cautious. He had always been skeptical of technology stocks, famously saying, "I don't invest in businesses I don't understand." That philosophy made sense during the dot-com bubble when many internet companies collapsed. But it also caused him to miss out on one of the greatest investment opportunities in history. At that time, there was one tech company that was growing faster than any other. It had a strong brand, an unstoppable business model, and was rapidly taking over the world. Buffett admired the company. He recognized its dominance. And yet, he didn't invest. That company was Amazon. Buffett had always been a believer in buying great businesses and holding them forever. And in the late 1990s and early 2000s, Amazon was quietly becoming one of the greatest businesses the world had ever seen. Founded by Jeff Bezos in 1994, Amazon started as an online bookstore but quickly expanded its offerings. Bezos had a clear vision. He wanted Amazon to become the everything store. Unlike most dot-com companies that flamed out in the early 2000s, Amazon survived and thrived because of its relentless focus on customers, innovation, and long-term growth. Why Amazon was a perfect fit for Buffett. Even back then, Amazon displayed characteristics that Buffett usually looked for in an investment. Heavy checkmark, strong competitive advantage. Amazon was dominating e-commerce and had little serious competition. It was building the kind of economic moat Buffett loves, one that only widened as time went on. Heavy checkmark, stable earnings potential. While Amazon reinvested most of its profits into expansion, it had a strong and growing revenue base. Its business model was becoming more solid every year. Heavy checkmark, exceptional management. Jeff Bezos was a visionary leader. He thought long-term, prioritized customer satisfaction, and reinvested in growth, just the type of leader Buffett admires. Heavy checkmark, fair valuation. At the time, although Amazon wasn't highly profitable in its early years, its stock was still relatively cheap compared to its future potential. By the early 2000s, Amazon had survived the dot-com crash and was on its way to becoming an unstoppable force. It had millions of loyal customers, an expanding product catalog, and a growing infrastructure that gave it a unique advantage over competitors. And yet, Buffett never pulled the trigger. Why Buffett said no to Amazon? In multiple interviews, Buffett admitted that he recognized Amazon's potential early on. But he also made it clear that he had one major hesitation. He didn't fully understand technology. Buffett had long avoided tech companies because they didn't fit his investment style. He liked businesses with simple models. Coca-Cola sells beverages, See's Candy sells chocolates, Geico sells insurance. But an internet-driven company like Amazon felt too unpredictable. Buffett has often repeated the phrase, "I don't like investing in businesses I can't understand." At the time, Amazon's success depended on e-commerce growth, cloud computing, and digital services, all industries that Buffett wasn't comfortable with. He admitted later, "I was too dumb to realize what was going to happen." Despite watching Amazon's meteoric rise, Buffett never bought a single share. What could have been the cost of the missed opportunity? Had Buffett invested in Amazon in the early 2000s, the returns would have been staggering. In 2001, Amazon stock was trading at around $5 per share. By 2024, Amazon's stock price has risen to over $3,000 per share before splits. That's a jaw-dropping 60,000% increase. Let's put that into perspective. If Buffett had invested just $1 billion in Amazon in 2001, Berkshire Hathaway's stake would be worth over $600 billion today. That would have made it one of Berkshire's most valuable holdings, possibly even bigger than Apple. Buffett's admission of regret. Unlike many investors who hide their mistakes, Buffett openly admits that missing Amazon was one of his biggest blunders. In a 2017 interview, he said, "I was too dumb to realize what was going to happen with Amazon. I didn't think Jeff Bezos could succeed the way he did. He had a dream, and he executed it far beyond what anybody thought possible." Charlie Munger, Buffett's longtime business partner, put it even more bluntly, "We screwed up." Even Bezos himself has joked about Buffett's missed opportunity. At a conference, Bezos once said, "I've been a longtime admirer of Warren Buffett. I even asked him once, 'Your investment thesis is so simple. Why doesn't everyone just copy you?' And he said, 'Because nobody wants to get rich slowly.'" Ironically, Amazon followed the same long-term philosophy that Buffett loves. It reinvested in growth, ignored short-term noise, and prioritized compounding returns, exactly what Buffett preaches. And yet, he still didn't invest. Buffett's first missed opportunity with Amazon was understandable. After all, the early 2000s were a risky time for tech companies. But what makes this regret even bigger is that Buffett had a second chance and he still didn't take it. The rise of Amazon Web Services (AWS). By the mid-2000s, Amazon was no longer just an online bookstore. It had transformed into a technology giant. In 2006, Amazon Web Services (AWS) was launched. AWS was a cloud computing platform that allowed companies to rent computing power and storage rather than buying their own servers. This was a game changer. For businesses, AWS provided heavy checkmark lower costs, no need for expensive physical servers. Heavy checkmark scalability, companies could easily expand their digital infrastructure. Heavy checkmark reliability, Amazon's global network ensured minimal downtime. AWS quietly became the backbone of the internet. It powered everything from startups to massive corporations. Companies like Netflix, Airbnb, and even NASA started using AWS to run their operations. The impact was huge. By 2015, AWS was generating $7 billion in revenue per year. By 2020, AWS accounted for over 60% of Amazon's total profits. Today, AWS is worth over $1 trillion on its own. At this point, Amazon was no longer a risky startup. It had a proven business model, dominance in e-commerce, a tech empire with AWS. And still, Buffett refused to buy. What stopped Buffett the second time? By the late 2010s, even Buffett's right-hand man, Charlie Munger, started questioning the decision. Munger openly admitted, "We made a mistake in not buying Amazon. We just didn't see it coming." But Buffett stuck to his old reasoning. He still didn't fully understand the cloud business. Buffett admitted that he wasn't comfortable investing in something so tech-heavy. He thought he had missed the boat. Amazon's stock had already surged and Buffett tends to avoid chasing high-priced stocks. Keycap 3, he focused on Apple instead. Around the same time, Buffett was heavily buying Apple stock, believing it was a safer and more understandable tech play. To be fair, his investment in Apple turned out spectacularly well. But Amazon remained a glaring omission in Berkshire Hathaway's portfolio. What could have been the lost billions? Had Buffett invested in Amazon during the rise of AWS, the returns would still have been astronomical. In 2010, Amazon stock was around $100 per share. By 2020, it had surged past $3,000 per share. That's a 3,000% gain in just 10 years. If Buffett had invested just $10 billion in Amazon in 2010, that stake would have been worth over $300 billion today. This single investment could have doubled Berkshire Hathaway's market value. Instead, Berkshire only had one small connection to Amazon. Todd Combs and Ted Weschler, two of Buffett's portfolio managers, bought a tiny stake in Amazon in 2019. But by then, the biggest gains were already gone. Buffett himself never personally made the call to invest. And he knows it was a mistake. I don't look back and say, I should have done this or that. It doesn't make any difference. What matters is what you do going forward. But when it comes to Amazon, he made an exception. Buffett has openly admitted that missing Amazon is one of his biggest investing regrets. Unlike most mistakes where he might have lost money on a bad investment, this was a mistake of omission. He didn't lose money. He simply didn't make the fortune he could have. And that is what haunts him the most. What Buffett learned from missing Amazon. Over the years, Buffett has spoken about the valuable lessons he learned from this missed opportunity. These lessons aren't just for him, they're for all investors. Keycap 1: Understanding technology shouldn't be an excuse anymore. Buffett avoided Amazon because he didn't fully understand tech businesses. But he now realizes that some tech companies have simple, strong business models. That's why he eventually invested in Apple. Pushpin Apple isn't just a tech company. It's a consumer brand. Pushpin, it has a strong moat with the iPhone ecosystem and loyal customer base. Pushpin, it generates massive cash flow, something Buffett loves. Had he applied the same thinking to Amazon, he might have seen that it wasn't just an internet company. It was a retail and logistics powerhouse. Keycap 2: The best companies always seem too expensive. Buffett has admitted that he often avoids high-priced stocks, fearing they are overvalued. But Amazon proves that great companies often look expensive until they don't. The best businesses will always seem too expensive. But if they have strong fundamentals, they'll keep growing into their valuations. This is something that newer investors, especially in today's fast-moving markets, can learn from. Sometimes, the price tag shouldn't scare you away if the business itself is extraordinary. Keycap 3: The power of compounding shouldn't be ignored. One of Buffett's biggest investment principles is compounding. He believes that small gains, if left untouched, grow into massive fortunes over time. And that's exactly what happened with Amazon. Pushpin Amazon didn't become a trillion-dollar company overnight. Pushpin, it took decades of reinvesting profits, scaling, and expanding. Pushpin investors who held on for the long haul were rewarded. Buffett missed out because he underestimated the power of Amazon's compounding growth. Keycap 4: Don't be afraid to admit you were wrong, and fix it. Even after realizing that Amazon was a game changer, Buffett never corrected his mistake. He could have invested in Amazon at any point, even after it became a household name. But he hesitated, thinking he had already missed the opportunity. It's not about how early you invest. It's about recognizing a great business and getting in while you still can. Many investors today make the same mistake. They see a great company but hesitate, thinking they're too late. But Buffett's Amazon regret shows that there's always an opportunity if you're willing to act. Buffett's rare moment of regret. Buffett is not one to dwell on mistakes. But Amazon remains a rare case where he openly admits, I was too dumb to see it coming. Even one of the greatest investors in history is capable of missing legendary opportunities. But the key takeaway is this. It's not about being right 100% of the time. It's about making sure you get it right when it matters most. And in this case, Buffett missed out on what could have been one of the greatest investments of his career. Keycap 1: You don't have to be first, but you shouldn't be last. Many investors believe that if they don't buy early, they've already missed out. Buffett made this mistake with Amazon. He thought the best time to invest was gone. But great companies continue to grow. Pushpin Amazon wasn't a trillion-dollar company in 2010, but it was still a great investment. Pushpin Tesla wasn't a trillion-dollar company in 2015, but it had clear growth potential. Pushpin Apple wasn't the world's most valuable company in 2000, but Buffett eventually bought in and made billions. Lesson: if you see a business consistently proving itself, it's never too late to invest. You don't have to be first, you just have to get in while it's still growing. Keycap too expensive can still be a bargain. Buffett has always been a value investor. He prefers stocks that are undervalued compared to their potential. That's why he hesitated on Amazon. It always seemed expensive. Pushpin in 2001, Amazon was at $5 per share. Buffett passed. Pushpin in 2010, Amazon was at $100 per share. Buffett passed again. Pushpin by 2020, Amazon was over $3,000 per share. Buffett regretted missing out. A great company will always look expensive. But if it's growing, today's expensive price will look cheap in the future. Lesson: instead of focusing only on the current price, look at where a company is headed. The best investments seem pricey at first, but they keep compounding. Keycap 3: admit your mistakes and fix them. Buffett knew he was wrong about Amazon, but even after realizing his mistake, he never corrected it. Pushpin instead, he watched Amazon continue growing while Berkshire stayed on the sidelines. In contrast, he didn't make that mistake with Apple. Even though he didn't buy early, he eventually recognized Apple's value and invested big. And it paid off massively. Lesson: it's okay to make investing mistakes, but it's not okay to ignore them. If you realize a company is great, don't be afraid to invest, even if you were late to recognize it. The biggest risk? Not taking one. Buffett didn't lose money by avoiding Amazon, but he lost out on hundreds of billions in potential gains. And that's something every investor should think about. Are you afraid of risk? Or are you more afraid of missing out on a great opportunity? Many investors hesitate because they fear making a wrong move. But the cost of inaction can sometimes be even greater than the cost of a mistake. Lesson: not investing is also a decision. And sometimes it can be the most expensive one you'll ever make. Buffett's final thoughts on his Amazon regret. Buffett has admitted that missing Amazon was a mistake. But he also accepts that no investor can be right all the time. At the 2018 Berkshire Hathaway shareholders meeting, he was asked about his biggest missed opportunities. His response: I don't worry about what I missed. I worry about what I can get right in the future. That's the mindset of a great investor. Learn from mistakes, but don't let them hold you back. And that's exactly what Buffett continues to do even after missing out on one of the most legendary investments of all time. Final words: how you can apply these lessons. Pushpin: don't be afraid to invest in growing companies even if they seem expensive. Pushpin: recognize when you're wrong and make adjustments. Pushpin: avoiding risk completely can cost you more than taking a calculated one. Pushpin: focus on the future because that's where the next big opportunities are. Buffett may have missed Amazon, but that doesn't mean you have to miss the next Amazon. So, the next time you see a great company growing, ask yourself, is this a company I will regret not investing in 10 years from now? Because in the world of investing, regret is the most expensive thing of all.